Hello and welcome to this week's US Stock Market Report. I'm Gillham, Chief Analyst at Wealth Within. This week I'll be discussing when is the best time to sell shares, and then I'll dive into the Dow Jones and this week's stocks of interest. Before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. So let's get into this week's report. One of the biggest challenges for those who trade the stock market is working out when is the best time to sell their shares. Usually a trader will be armed with many theories on how to pick the best trades to enter the market. But when asked where they should exit, you often get a confusing array of examples that are, in most cases, more guesswork than solid theory. The fact is that if you want to be a consistently profitable trader, not only do you need to know how and why you're buying shares, but more importantly, you need to know where and when to sell your shares. A common statement made by many traders is that they can only ever achieve a good profit if they can pick their entry well. However, while this statement has some merit, it is only partially true, and in my opinion, not the most important element of a successful trader. It is possible that you can be right in your analysis less than half the time and still be profitable, as long as the winning trades outperform the losing trades. However, what I'm proposing is that trading is not just about buying winning trades. Rather, trading for profit is about using sound money management rules and good exit strategies. You may have heard the statement that you can't go broke taking a profit. In my opinion, this is a myth that is not only detrimental to your trading, but one that will set you on a path to financial mediocrity, as it will cost you a lot of money. While we acknowledge we can be right less than half of the time and still make money, we can only do this if we allow our profits to run and cut our losses short. This is because you can be right 4 out of every 5 trades, but your success and profitability will depend on how you handle each trade in regards to your money management and exit rules. Let me explain. If you have 4 winning trades that make 20% each, and a losing trade that loses 10%, then you're profitable. You would have made 80% profit and lost 10%, which means you've made 70% overall. However, you need to remember that if you lose 10%, you need to make 11% to break even again, as you have less capital to reinvest. Now let's look at a slightly different example. If you decide you're happy making 10% on your profitable trades, and you lose 20% on another trade, then your profitability changes dramatically. Let's say you have $5,000 and you place $1,000 in 5 different trades. You would make $400 in total on your winning trades, and your losing trade would cost you $200. As a result, your $400 profit is reduced by half to only $200, and your total return for the 5 trades is only 4% gross before costs. Let's not forget the fact that when you lose 20%, you need to make back 25% to break even. So the more you lose, the harder it is to get back on top again. And if you allowed the losing trade to continue to fall to a 40% loss, you would be in an unprofitable position on your whole portfolio. How many times have you decided to take profits on a trade before the stock told you that it wouldn't rise any further? And how many times have you lost 20 to 40% on a trade? If you're not a consistently profitable trader, then you need to look at your money management rules and your exit strategies rather than spending time trying to pick the next big winner. So how do you know when to hold on and when to sell shares? The answer is really dependent on the length of time you want to trade and the type of market you are trading. Of the thousands of traders I've spoken to and assisted over the years, there is a very consistent theme that continues to shine through. Traders tend to exit profitable trades too early for fear of losing profits, or they exit before the stock indicates to do so. As a result, the trader experiences a lot of minor losses and low profitability, which in many cases means they lose overall. Remember, the market is not 100% black and white. Therefore, you need to allow room for the market to move. We cannot say that a market or stock will turn at an exact point in time or price. We can only indicate with a probability derived from our analysis that this will occur. One of the most important rules I've ever learned is to always trade on confirmation rather than speculation, which means you should never make a decision until the market tells you what it will do. It is very common after entering a trade for the inexperienced or uneducated to exit after a stock has moved down for a few days or even a few weeks, only to see it rise back up to make a nice profit after they exited, which usually results in lots of small profits. When I explain that this is detrimental to their overall profitability and that they should implement some rules to protect capital, they are often surprised to learn how much more profitable they can be by following some simple money management rules. Often a trader's reaction to exiting a stock is based on their fear of losing and a lack of faith in their trading plan, if they have one, or their ability to be profitable. I guarantee you that if you have a written trading plan that you've backtested over many years on many different stocks that has proven you can be profitable, you will have faith in your plan and your ability to enact that plan. Indeed, this will give you the confidence to know when to hold on and when to sell your shares, as you will understand the personality of the stock. I personally hand charted 5 stocks for a whole year before I started trading, and I backtested my trading plan to make sure I could make it work and make money. Yes, it was hard holding back from actually placing my money on the market, which is common with most people, because in my mind it felt like I could be making money if I was trading. But the fact of the matter is that without the knowledge and confidence to understand how the stock will unfold, it is highly likely you will end up losing most, if not all your money, because you are ill prepared. Think about it. If after reading a book on skydiving, I said to you, hey, let's go and jump out of a plane, you'd probably think I was crazy and a risk taker. In fact, I'm sure if you were standing at the door of the plane with nothing between you and the ground, you'd be wishing you'd spent a lot of time practicing the skill to ensure your success. The best traders I know spend a great deal of time practicing and backtesting their trading plans, and you can guess who are the most profitable on the market. As I mentioned previously, knowing when to sell will depend on the market you are trading. For example, if you're trading blue chip stocks over a medium term, then setting a price target on a profitable trade, which is common for many traders, is what I call financial suicide. This is because your job as a trader is to take the lowest possible risk each and every time you trade. So why would you consider exiting a profitable trade when you know with 100% certainty that the stock is trending in the right direction? Not only will you be taking smaller profits, but you will most likely enter another trade that you don't even know will be profitable. If you're using trend following indicators such as trend lines or moving averages, let these tools do the work for you by telling you when and where to sell your shares. Do not second guess them by exiting early. Setting tight stop losses on blue chip shares is another reason why many traders fail, as they end up selling their shares too early for fear of losing. Once you enter a trade, you need to let the stock settle into a trend. But if you set a stop loss of around 5%, for example, not only is there very little room for the stock to move, but you will decrease your profitability. Therefore, the minimum you should set your stop loss to know when to sell your blue chip shares is 10 to 15% below your buy price, although this will depend on the volatility of the stock. That said, regardless of the market you are trading, I cannot stress enough that the most important aspect to your success in the share market is to prove to yourself that your trading plan works by backtesting it. If there are any deficiencies in your trading plan, it will dramatically increase your probability of losing. As traders, you also need to be aware of your win-loss ratio, or how many times you win compared to how many times you lose, and your profit-loss ratio, which is how much you win compared to how much you lose, as this tells you how profitable you are. Once you understand these figures, you can work on improving them so you can become more profitable. I outline in my latest book, Accelerate Your Wealth, It's Your Money, Your Choice, not only how to set up various stop losses, but also how to determine the overall profitability. So let me say, if you decide to heed the practicality of the information in this video, you will become a very profitable trader. If, however, you decide to enter a trade without knowing when the best time to sell your shares is, you are gambling. And unfortunately, gamblers always lose. Consistently successful traders, on the other hand, are risk managers who understand that gaining a solid education in trading the stock market will pay them back tenfold. So let's get into the stocks.
Okay, wasn't last week quite interesting? So that's the week ending the 7th of December. And you can tell by looking at that last bar on this weekly chart of the Dow Jones. I mean, have a look at this bar here if I just scroll it up. Your previous close on the here on what is it? The 30th of November was 25,538. It got right up through here, traded up, and then just fell away. And it's closed a little bit above its low there. But as I said, I'm still a little bit more bearish on the Dow. I'm not super crash type bearish, if that makes sense. If you look at it in a bigger context, let's go to the monthly chart, and always go back to the monthly chart. If you're looking at daily charts, and I'll show you a daily chart in a second, you'll be more fearful of the market than you are if you're looking at a monthly chart. It completely changes your picture. It's like looking at something with a telescope. If you're looking at something really scary in a telescope, it looks really close, but then when you pull your eyes away from the telescope and you can see it in the long distance, ain't so scary anymore. And looking at this, you can see how the Dow's been so bullish. Because remember, October, it was its all-time high at 26,951. So it had its all-time high, and that was late October, I believe. It had, I think it was around late October, I think. But we'll have a look at that on the daily chart. It's had an inside bar here where it actually closed higher than it did in October, and so far, December has closed a bit lower. Again, I'm still thinking sort of 22,000 point level, maybe a little bit below, but I think it will go anywhere between 10 to 15, could even go to 20% fall from its high, and that's 15.49% is around that 22,500 point level. So to me, it could go to, sort of 23, it could go anywhere between sort of here, well, not here, sorry, it's more around sort of here-ish, right down to here, but I don't think it's ever going to get down to 21,000, which is a pretty big fall, a 21% fall. But it's possible, but more likely it's going to find some support around 22,527. But let's have a quick look at the daily chart, and you can see how the Dow has been all over the place. It had a gap there, it's filled that gap, it's filled this gap, had a little gap there, it filled that gap before it fell away. And gaps are interesting in terms of trading, especially more if you're looking like little short-term trading. But again, there's another gap there, it filled that. But interesting, when stocks do gap, it tells you things about the psychology, and obviously this is an index, which is quite interesting that it's gapping around. Index don't tend to gap as much. The Dow's doing it, but normal indices don't tend to gap too much. If you look at some of the other world markets, you won't see them gap too much. Dow, as I said, the Dow's a little bit different here. But I wanted to show you a couple of things. One is I wanted to show you like the world or international indices, and I'm showing you a relative rotation graph, and I won't explain this because it'll spin your head if I start explaining it too much, other than keeping it really simple. All I want you to do is, if I look at this point where the apex is between all these coloured squares, that apex point, all you need to remember is that's the S&P 500, the US S&P 500 index. That's all you need to remember. And all what you're seeing here is World Indices, and this is a monthly. If I look up the top, it's 1 month. And if you look at this bar here, if you look here over where my pointer is, it says it's 10 bars, which is 10 months. So it's relative to 10 months of time. So it's showing you the movement of these world indices over the last 10 months compared to the S&P 500. And you'll see leading over in the top right-hand corner, you'll see weakening down here on the bottom right corner, lagging on the bottom left, and improving on the top left. All that's saying is these leading or lagging the S&P 500. So right now, the New Zealand 50, pretty small country, but awesome country. I love going to New Zealand, and as an Aussie, we all love going to New Zealand, especially for skiing. But you can see the New Zealand 50 is absolutely creaming the S&P 500. This means it's actually outpacing the S&P 500. It's rising faster and by more points, percentages, or percentage-wise, and faster in days than the S&P 500. You've got this one here, and I don't even know what that one is, BSEN, whatever world indice that is. But you're looking at the Dow is running it says it's weakening, which means it's actually running faster than the S&P 500, but it's weakening towards that. The Compex, the Nasdaq 100 is weakening. It's still running faster, but it is weakening, and the Compex, the Nasdaq Composite Index, is also running faster. So there's stocks in there that are running faster than the S&P 500, but they are weakening, which is showing you the overall market in the US is slowing down. If you're looking for world markets that are the hot ones right at this moment, are the ones to get into. Because remember, the ones that have already run, you don't want to get onto them after they've run. You want to get onto them before they've run. And the ones that are going to start to run or starting to run, the All Ordinaries Index in Australia. This is another Australian index, the S&P 200 in Australia. It says it's improving. I would be buying these right now. That's what if they were stocks, I would be buying them, and they're not. You've got the TSX Composite Index. You've got the FTSE in London. They're the ones coming up from this, lagging up into this sector. They're the ones you want to be looking at. The DAX over here, the CAC, the Straits Times Index in Singapore. What's this blue one over here? Look at this one. The SEC over here in the Shanghai Composite, looking pretty average. I wouldn't start looking at this for a little bit, and I don't even know what this brown one is. Here we go. The VIX, how's that? The volatility index is turning over. But interesting, it's just showing that the volatility in these indexes the VIX is showing volatility starting to drop away. But anyway, what you need to do is looking at this. Now, obviously, most people aren't into buying world markets. What this is showing me, that is everything compared to the S&P 500, which a lot of the world is marking itself against, and you know that because you watch the news, is that the US market is slowing down and it is turning over, where other world markets are starting to look a lot better. Most of them are over in this weakening sector, the lagging sector, and they're all going to turn up and move up into this improving sector, while the Dow, probably the S&P 500, the Nasdaq, those sorts of things will keep moving down into those, and they'll fall away a little bit. So that's what we're looking at here. I just want to go into the S&P 500 watch list. Now, this is all down this list is all 500 stocks. If you look at that, if I can scroll through them all, and this is all just in alphabetical order, starting from Gillham Technologies. Hopefully I said that correct. It's got the stock code, the open, price, the last, and it's a weekly one I've got here. I can do this daily or monthly. The open, the last, the high, the low, and the percentage change for the last week. So obviously red means it's negative and green means it's a positive. But let's order them in terms of the price, the movement that happened, or the price change for last week. And you can see the most bearish was SVB Financial Group at 19%. American Airlines down 16. Bright House. Some of these, E-Trade, another one, 12.53. AIG, big insurance company, down 12.37. FedEx down 12. There's just State Street Corp, big fund manager, 10.93. And you just look, Bank of America Corp down 10. So a lot of the banks weren't doing very well. Financials weren't doing well. Citigroup's down here at 9.94. And I can keep going right down. Vita Corp is in the tech sector, down at 9.6. Harley Davidson down nearly 10% as well. So you can look at these and say, well, hey, what is this actually telling me? And pretty much it's not telling you a lot. And this is what a lot of people actually do. They look at these and they go, oh, wow, so-and-so is down this much. And if I go and look at the chart of this SVB, you can see here, this is the daily chart. Let me go to a weekly chart. And you can see it's been quite bearish. And right now, this is really, really bearish. And so I would stay away from this sort of stock. But then people look at, well, what's the biggest growth ones? And so if I go click here, you can see here last week, you had all these stocks that went up in price. Edison International, NRG, Twitter went up 4.39. First Energy went up I think that's how you say it. Kimco, Newport, Ventress, Realty Income Corp, 2.7. So there's really some stocks there going up, but it doesn't mean they're actually going up in price. Let's have a look at Twitter, and there's a daily chart of Twitter. I'll change it to weekly, and you can see here's Twitter, and it had its recent high in June. It's fallen away, but it's looking reasonably bearish, even though it was bullish in a more bearish market, because we've looked at the Dow, and we know the Dow is a little bit more bearish. So how do you work this sort of stuff? And it really isn't something looking at these daily prices and looking at movements over a day or a week really doesn't tell you a story at all. It just gives you information. It doesn't tell you what you should be looking at and buying. If I now change that to a yearly chart and we look at this and we see the Dow, if we look back at the Dow, we know the Dow, let me just go back in here. It's giving me what I want. It's just adjusting everything. So just watch down the side there. It'll let me do what I want to do. Okay, it's calculating everything. So now the Dow, if I look at the Dow on a yearly basis, whoop, that didn't work too well, did it, guys? Okay, here we go. We can see here that 2018, it's only slightly down from where it opened. It opened up at 24809 and currently closing at 24388. So it's down about 500 points. So it's not a lot for over a year. So it really hasn't done too much. But if we go back to this watch list, now you're starting to look at stocks that have gone up, even though the Dow's gone down fairly heavily. So Under Armour, TripAdvisor up huge. These sorts of stocks, they've already run, and a lot of people will start looking at these stocks for them to buy, because you can go, let's open that chart and look at that. It's looking quite nice, but in terms of its run for this year. Now I'll take it off the daily and let's put it onto the monthly, and you can see how it's done very, very, very well over this period of this year. So here's February, January. It's done beautifully. Under Armour, a nice clothing manufacturer. But is it something you should be buying now? And this is what a lot of people look at. They look at the 52-week highs, those sorts of stuff. Not the way you pick stocks. And I'm showing you these sorts of stuff. It's stuff that I look at and I see people make real bad mistakes with all the time. It really is. I'd rather look at stocks that are going down, is the opposite, and have gone down for some period of time and wait for them to find some support. Here we've got GE. So look at GE. It's just gone down and down and down and down and down. So if I now go to a monthly chart and look at GE, now that's not all the data on GE. It will download the data, but you can see here. Very, very bearish. I will wait for it to find support and have patience waiting for it to find some support to start moving up. So then I'll start filtering these stocks in terms of sectors they're in, and also how in terms of the indices they're in, is looking at which one should I be in. So I'm not looking at the small specky type of stocks. I'm looking for good stocks to actually wait for them to stop falling and then start to rise. So looking at some of here, you've got Kraft Heinz, down 39.29%, PG&E Corp, another one. So some of these, now I'm not a big Western Digital Corp, another good one, 50% down. So I'd be looking at that sort of stocks. Not to buy right now, but putting onto my watch list. And this is what a lot of people don't do. They react to something going on in the market rather than find a watch list, sit back and wait. And that's some of the stuff we teach our students, to really start to have forward planning. So what I'm bringing on in the next 6 months or next 12 months or next 3 months, and knowing the stocks are coming back. So I might put 10 or 20 stocks on my watch list. Now I might end up buying 3 or 4 or 5, but I'll be ready for those 3 or 4 or 5 rather than reacting to the market and seeing what's going on. And we often buy stuff. American International down 38.43, another one. There. So there's just this keep going on. I can find a whole list of really, really good stocks, but you filter 500 down into via liquidity, volatility, market cap, and what they've been doing, and just narrow down into a smaller group of stocks. That's really simple. It's not that hard, and people think you got to spend hours and hours and hours and hours doing it. You don't. If you have a nice process, you make your job really, really easy, and software like this helps do that as well. So I haven't really talked about a specific stock on whether what they're doing at this point in time on this recording, but what I'm suggesting is there's plenty of things to look at in terms of the market. Obviously, with world sectors, which is what's on your screen right now, you can see last week that the All Ordinaries Index in Australia was up 0.15%, and the Shanghai was up 0.6%, but other world market like the Dow was down 4.5%, the Nikkei down 3.2%, the DAX in Germany was down 4 points, Nasdaq was down only 5% there. So these are the sorts of stuff I actually do look at, and I get down into sectors, but it doesn't take long and it doesn't take much to be able to do it, to bring it all down to where your money should be going and what you should be looking at. But if you have a knee-jerk reaction to stocks in the market, then it's just telling you need to understand a little bit more. You don't have enough knowledge. So hopefully this has been an interesting recording for you about what we're doing. And you notice haven't really talked anything about what's going on in the news, because what's going on in the news is causing the volatility, but it doesn't move the market. And you need to separate the two. You might get journalists saying, oh, the market's down, blah, 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 the market's bearish, the market's this, the market's that, the market's whatever. Well, journalists aren't the experts, okay? And all I need to do is, I don't buy the market, I buy the stocks. So I'll buy the, Procter & Gamble's, or the Apples, or the Microsofts, or the Hewlett-Packards, or the GEs, or the GMs, and the Fords, and all that sorts of stuff. You'll buy the stocks. You won't actually buy the market. And so by eliminating a lot of the noise, as you saw when we looked at that yearly, the yearly list, you can see how much, if you look at the right spots, I just flip it over again, how much money you can make in a year, even with the market not doing very, very much. If you look at stocks that are good and they've probably fallen away and they're starting to move back up again and do really, really nice things, here's Twitter that we looked at before, and you saw how it looked a little bit bearish, but over a year it's done really, really well. Look at that beautiful new rise. Now you could have bought in and got out of that and made some really, really nice money with some nice little rules, and you would have, based on the rules that I teach. But interesting, as I said earlier, people don't have rules generally. They speculate on the marketplace. So good luck. If you've got any stocks you want me to look at in as far as the US market, or please type them down below. If you've got any questions, please type them down below. If you're fearful of the market and you're not sure what to do, remember, get my book. It's available in bookstores. It's available online. You can get it on Amazon. So Accelerate Your Wealth. It will give you rules and tools, a strategy, and a trading plan to help you do exactly what I'm talking about here. So really, really, really help. It won't tell you exactly how I do it like this, but it'll give you a simplified way of doing that, if that makes sense. A lot more simplified, because as I said, it's not difficult what I'm doing, but you need to know some simple ways to do it if you're more of a beginner, or even a bit of a trader, but you're not at my level, if that makes sense. But the book will give you strategy, structure, process to be able to do this for yourself. So narrow down a big watch list to specifically what you're needing them, and then make your life a hell of a lot easier and a lot more profitable, with a lot less stress and a lot less fear about what's going on in the marketplace. And one thing I'd suggest you to do is write down what the market's been like the last month, and the volatility and the news and what's been going on. And then in 6 months' time, go back and read your notes, and because you'll forget. Because November, the news in the market in November is all about doom and gloom. October, November is all doom and gloom, or blah, blah, blah. But even in a year's time, go back and see, and then check it on the chart. And it's interesting when you go back and look at what happened in the news before the GFC or the tech wreck, or all sorts of different things. When you live through them, if you write down what's going on and then what actually happened, you'll actually find that having more of a contrarian view will actually make you more money. So that's it for me this week. Look forward to chatting with you next week. Bye-bye.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.